Great to be back at SaaStock, and I'm really delighted to have three amazing panelists here to talk about fundability for SaaS companies now and in the coming 6 to 12 months or so, which I'm assuming is a very relevant topic for a lot of founders, especially in the audience. So maybe we start with a really quick round of intros, and then I'll try to learn from you, and for the benefit of everybody here, really what you're looking for with respect to SaaS companies, and we can obviously also talk a bit about like the macro environment, which has an impact on this, and take it from there. But maybe we start with you, Melissa, and then over here.
Yeah, absolutely. I'm Melissa from Notion Capital. We're London-based, early to say seed to Series B, but a lot of Series A, B2B SaaS fund. We invest right across Europe, but like I said, based in London, and travel from there. Yeah, not much more. I suppose we invest in everything from B2B software, so be that fintech to SaaS-enabled marketplaces to vertical SaaS, and everything in between.
My next, great. Hi, everyone. Delighted to be on this panel today with you guys. My name is Evgenia Plotnikova. I'm a partner at Donohoe Capital. We're a software-only fund and have been for the last 20 years before everyone else thought it was cool. We invest in Series A and Series B, and there's been a bit of a lettuce soup over the last decade. I'm sure we'll talk a little bit about that. What that means to us is that companies that have found their product market fit and they're scaling their go-to-market machine, people and processes. And we've recently raised 700 million, and so we're very much in the market and ready to invest.
Thank you, Evgenia, and Anant.
Sure. So, yeah, I'm a partner at this firm called Bessemer. I'm based out of India, and most of my investments tend to be in companies, mostly software, which are scaling from many different parts of the world, including India, including Europe, but trying to sell globally. And that's one of the things we love about software as a firm. It can actually be sold wherever you want to sell it, and it can be made wherever you want to make it. And as a firm, we usually do Series A and beyond. We do a few seeds as well. I don't do as many seeds, but we've got like a stage-agnostic fund. And super excited about Europe, super excited about software, and most excited about being on this panel with all these amazing people.
Great. Thank you. I'm Christoph from Point9, by the way. So I want to ask you in a second to tell me, and more importantly, the audience, really as precisely as possible what you're looking for in a SaaS company. But maybe for some context, I think if we take a step back and try to remove ourselves just a little bit from the echo chamber that we live in every day, I think you could think that everybody, at least the investors in this room, are totally crazy, right? Like about 2 years ago, they valued a typical SaaS company at 20 times revenue, sometimes 25, 30, and then there were the occasional 100 times ARRs company. Now, the same companies are valued 6 to 8 times ARR, maybe some of them 10 times. But basically, the same companies are almost suddenly worth 60, 70% less. So I guess the question is, were we crazy at that time? Are we crazy now? What is normal, or how can all of this be explained? And there's probably something that which we could discuss for hours, but maybe have some some hot takes on that. Whoever wants to start.
I'm happy to start. Well, I heard that you have a new version of the napkin. So I'm going to do a little promotion for the SaaS napkin of Point9, which has all the criteria that you need to raise seed, Series A, and beyond. But I guess, look, to answer your question, Christoph, I think Well, first of all, to be a founder, you have to be positively insane a little bit, right? To truly believe in an idea and work on it for 10 years. And so probably as a VC to invest in a lot of founders, you have to be a little bit insane. But private markets are imperfect, right? And it's a question of supply and demand, as well as broader macro, whether it is the influence of the public markets or the interest rates or the overall economy that have influenced the multiples. I think from my perspective personally, it ultimately doesn't really matter because it's all at point in time. And I think what we have forgotten is that entrepreneurship is hard, and it takes a decade to create a business of value, to grow it in a way that is sustainable and significant. Ultimately, it's not about the valuation at a Series A, B, or C, which are all a little bit of ego metrics, with the due appreciation for the dilution that the team takes. It's about what you put in your pocket at the end of the day and the value that you create. And I think for that, what we have always looked for and will continue to look for is founders solving real business problems, real pain points, catering to a sense of urgency in enterprise, not the stuff that disappears as soon as the markets turn. And I think that's probably the most important thing for us. But for metrics, I turn to you and your napkin.
Yeah. So are you saying that, like, for you, you're trying to not be like impacted as much, like by maybe comparables from the public markets, which obviously have the probably disadvantage of being priced every day or every hour, every minute, every second?
I guess what I'm saying is that we're trying not to be hype investors, and what we'll look for is fundamental business value, and that will pay wonderful prices for wonderful businesses, and will do the right thing to remain competitive and to do the right by our LPs to continue being in the business and invest. And sometimes that means that those prices may be higher, and sometimes they may be lower, but we're in it for the long run. With the series of the funds that we have, we can go all the way from early to pre-IPO, and we see through that journey alongside our founders.
Yeah, thank you.
Yeah, I think, to your point, there's no way you can avoid the impact that the macro environment's having and the public markets on valuations, and how we are seeing that trickle through. I think from our perspective, like I said, Notion, we invest primarily at Series A. We're seeing that come down now to Series A, but really it was most significant, I think, at Series B and the later stage. I'm not I will never say I'm a macroeconomist by any stretch of the imagination, and I think it's difficult for us all to sit here and pretend that we are and can hypothesize on how rates will change and the inverse relationship on valuations and all that good stuff. But I think in terms of your question, were we all mad last year? Is this now a reckoning and a return to normality, or are we in a low cycle and those kind of valuations will come back? I think what we're seeing now is, yes, we might be on a lower end of the curve, but I think it probably is a bit more of a return to a normal. And perhaps we did all, valuations, particularly at the early stage, got ahead of us somewhat. And I think we feel that in terms of the investor interest and concern around fundamentals, things like efficiency and real value creation, like Evgenia mentioned, that has remained and always has remained priority to us. I think we're very lucky in the sectors that we invest in terms of B2B software. If you can carve that out, it's when you look at the broader macro markets, it's very easy to get a bit dismal and depressed. But if you look at how B2B SaaS is performing within that, it's performing very strong. I think the Nasdaq has surprised everyone. It's doing quite well. We've got Klaviyo with some green shoots there, of course. So for us and where we invest in the companies that we back, I think there's a lot of reasons to be very positive. From then, in terms of what we look for and what I would say to companies that are fundraising or expecting to fundraise in the next couple of months, if you step back and see this valuation peak that we might have had last year in some rounds and a bit more return to normal now, I think one of the big learnings that you can take away from that is to remember throughout your journey as a venture-backed startup, you're not raising with just one particular milestone or phase in mind. You're raising to get from 1 to 100 million and build that billion-dollar unicorn outcome. You're not just raising to get to your seed and then get to your Series A. So optimizing valuation and optimizing how you look at your valuation trajectory and your funding trajectory from that 1 to 100 million or throughout different stages is important, and to make sure that you can keep up with a growth rate and have year-on-year growth that matches that valuation. Because yes, in business cycles there might be peaks and there might be troughs, but you just want to be able to bring your journey throughout and make sure that you can maintain that growth trajectory and the valuation trajectory over time.
Yeah, and I mean, I think a lot of, totally agree with everything that was said, and the only thing which I'll add is, let's go back and think about why we all love software. Why did we all invest so much in software? Why do we continue to invest in software? The fact of the matter is that with SaaS, you invest, say, $1 in sales and marketing, and if you can use that to generate $1 of revenue, it's usually really high gross margin. And that revenue usually stays, if you have 100% plus NRR, it usually stays for many years. So that repeatability in software subscription, the high gross margin, and the fact that that $1 of sales and marketing can get you almost a very long-term source of recurring revenue, that hasn't changed. So fundamentally, software is still a good place to be in. And if you're a founder today, the only thing which I would say that you should spend time on is, can you get to that mathematical equation? Can you get to $1 of sales and marketing, generating $1 of revenue or more at a high gross margin for a long time to come? Because if you do that, yes, markets will come and go. Somebody in DC will wake up and change the monetary policy. Somebody will do something else in London, something else in China. But your customers are still going to be paying you revenue at high gross margin. And you can continue to reinvest that for sales and marketing and keep generating that revenue, keep generating that flywheel. And to do, and to that is, to that effect, we actually think of companies not as unicorns, but as another mythical creature called the Centaur. Can you get to $100 million of ARR? And if you can do that with less than $100 million of capital, that is a 1:1 sales and marketing to your recurring revenue ratio, I think you'll find capital, and I think you'll be in a good spot in the coming years.
Yeah. I think we can maybe double-click a bit on what you said about that predictability that I think everybody aspires to, and that hopefully you have at a certain stage. I think it usually takes quite some time, right? And I don't know if you have any advice on a company, let's say at a Series A or a Series B stage, which has some history but not that much history. So as an investor, I'm assuming you want to know that this company can take 20 million and turn it into X of ARR or lifetime value, because then in a spreadsheet it's all great. Right. But how can you prove, or to what extent can you prove the scalability of your customer acquisition when you've only spent a couple of million in the past?
That's a great, question, and to be honest, we think about it as investors, at least, and I'm sure we all think about it every day, because when you've got to invest 10, 15, 20 million dollars in a business, you're asking yourself the same question that, hey, I have 18 months of data, but is that enough to draw a line? And the honest answer is it's not. But I think as a founder, what's important for you to do in your business and then communicate is, I think the most important thing is, almost every software market is large, at least that's what I think. The most important thing is, have you identified your ICP, and have you identified where they exist? So for instance, if my customer profile is a mid-market HR director, have I identified that with a certain amount of conviction that, hey, I know HR directors in companies with 500 to 1,000 employees are the right buyers for my product? And if you can communicate that and then say, hey, now I have to go and find 1,000 of these HR folks and convince them to buy the software, I think that's what I'm looking for personally. I'm looking for that clarity in the product. The go-to-market metrics always change. I mean, we index so much on these numbers, but the fact is, like you said, that we don't have enough data. And my favorite example for that is, I was looking at this company, they're an SMB software company, They're like, oh, we've only lost 1% of our customers till date. And if you think about it, that's an amazing stat. I'm like, wow, that's great. Like, how did I not meet you all before? I should have done the last round. But then you think about it, the company's been around for like 18 months, and they're only selling annual upfront plans. And they've grown 3x in the last 12 months. So if you think about it, less than 20% of their customers have had a chance to churn. So you can get really excited about that metric, but the fact is that it's not really relevant. What's relevant is, have they found who their customer is? And do you as an investor believe that there's enough of those people? And then you trust the entrepreneur that they'll figure out how to get to them. That's just my view, but yeah.
And regarding the market size, maybe for you or for any of you two, I think the advice to founders, which I also agree with, is generally to start with a small market or at least a small segment, because you can't be everything to everybody. So you have to find a narrowly defined ICP and hopefully deliver an awesome solution to them, and then the word will spread and you can expand from there. At the same time, investors, especially investors who want to return billion-dollar funds or funds with hundreds of millions, need big outcomes. So they need to have some belief that there is actually a much bigger market beyond that. I don't know, do you have any advice on that? Like in your example, like if as a founder I have a great product market fit, but it's in a tiny segment, like would that be of interest to you? Like would you take the leap of faith that they can then crack the next adjacent market to that, or would you wait and see until there are proof points for the bigger market?
I think I lie in the camp of each market is large, and if you can solve for one market, I'm willing to take the bet that you can find other markets. But yeah, I would love to hear from you.
I think it probably depends, Mark. It depends on the application and the company that you're building. I mean, some businesses will lend themselves more easily to either global or international expansion, European expansion. Other ones that maybe are heavy on regulation or compliance or very country-to-country specific issues, they will obviously be a bit more difficult. From my perspective, I like to invest in companies, and in Notion we like to invest in companies that have a strong product and software angle, and it's not just a pure, say, distribution play. Which brings us back to what we're looking for. I think if you take as a kind of de facto a truth that the market that you're building into is big enough, there's enough people that you can ultimately sell to, and that our homework as an investor as well, there's a belief that we think that this product can scale, be that in a vertical way, if it's a vertical business and you can really go deep in what you're building, or you can bring it across borders or across countries. If we believe that and can see that happening and think that the team is capable of doing so, for us it's very important to see them whittle that down to a beginning ICP or a customer segment that you can start with, build a product and a software tool that the customers love. And to your point, I would get a lot more excited about a company where I see that initial cohort using and engaging the product in the right way, showing good repeatability, showing good stickiness, being an ambassador almost for the company itself, than having signed up 1 million in ARR and that of non-ICP customers that may or may not churn next month, and you have to spend your 5 million seed round to get them there. So we can get tied up at metrics that when you step behind, a 1 million ARR business could be a hell of a lot less exciting than a company that's built a product that its initial test customers or its initial ICP really love coming back to, and that we as investors see that expanding across or into a big enough market to build a big business.
Okay. Let's talk a bit about growth expectations. I don't know, maybe starting with you, Evgenia. Growth and efficiency, obviously that's something I've been talking a lot about in the last 18 months, and which is, I think, top of mind for many people, because almost suddenly about 18 months ago, investors started to be no longer willing to fund growth at almost any cost. And when we did our annual SaaS napkin survey last year and this year, efficiency was one of the things that investors pointed out they are more, they care more about. The question I think for founders is, what is the growth expectation that comes with that, given that there is a higher expectation with respect to efficiency? I think it wasn't so clear from what we learned that the growth expectation has been significantly lowered, which is a difficult message for founders because it's basically you have to achieve the same with less. I think this year growth expectations have come down a bit, maybe it's unavoidable. But I'm curious, like what gets you excited as a Series A or Series B investor? Like what would you say is the minimum growth that you would see to even take a meeting, maybe?
Well, you mean every board member would ask you to grow faster and burn less. I mean, look, I think the reality is that at the very early stage, growing fast to achieve scale is unavoidable if you want to build a big business, right? I think there are plenty of phenomenal businesses that should never get on the VC treadmill, that are fine to be compounding for a long time and building an entirely self-sufficient and sustainable manner. And I think that's a choice, and that's fine. However, if you do get on the VC treadmill, it's the one that you then foresee to be on for the next decade, and that means that it has requirements of getting to a certain size at a certain pace. So I think sort of growth expectations without, I don't have a specific number. I think it is dependent on the type of market you're selling in, the ACVs, and the stage of your journey, whether you're an early A B, or a C stage company. What I think has definitely changed is we had 2 years of gluttony where capital was free. And so it was okay, or it felt okay perhaps, I don't think it necessarily was okay, to throw money at the wall to see what sticks. I don't think we have the luxury of that experimentation with capital. I think capital has become more expensive, and so it's having your growth be perhaps more staged or assigning a degree of focus to your go-to-market machine to scale it in a way that is a little bit more sustainable. I think that's the big difference.
Any additions from you?
Yeah, I think completely agree. I think, and I'm going to quote you at some point on the gluttony piece. Yeah, the most practical advice that I give to, or the practical advice that I give to my portfolio companies when I'm on the board is, in a capital scarce market, what is important is, can we do more with the money that we have? And one objective way of looking at that is, all the money that I invest in sales and marketing, can I get it back within a certain time period so that I can reinvest that again? Because the good part about software is you invest $1 million and like whatever you get back at like 80% gross margin, so you get most of it back. So my rule of thumb is, if you've got money for 18 months, based on the current burn rate, then take a number less than 18 and say, can I recover my sales and marketing spend or my CAC? Or can I make my CAC payback less than the runway that I have? And don't make it too less. Like if you've got 18 months of runway and you're saying, oh, I just want to get my CAC back in 2 months, probably not the right number, but yeah, 15 is also not the right number. I index to somewhere between 9 and 12. And I think that is the practical advice which I give to my founders, that index your CAC payback to your runway. And then with that CAC payback, whatever is the highest growth you can get that, because that's probably our outer limit.
I think a lot of founders think that they kind of have to meet a certain bar, let's say growing 2x when they are at a few million in ARR, or maybe 3x even at a smaller scale. And that can lead to CACs exploding, right? Because the last 20% points of growth might be extraordinarily expensive because the low-hanging fruits are all gone, right? So because of that, I think it's really useful to know, like is it acceptable? Can I still raise a Series B or Series C if I'm maybe at 10 million ARR and growing 50% year over year?
I think just to maybe add to what you were saying, Anant, is it's not necessarily just sort of the mechanical calc for me personally. I think it's very important. I think you should be, if as a founder you're not aware of unit economics, if I wake you up in the middle of the night, something's gone terribly wrong. But I think it's, for me, what's more important is the repeatability of the use cases. I have been surprised over the years to meet some founders who didn't appear to be truly listening to their customers. I think it's not just kind of, oh, you know, I've sold to 5 banks for 50K or 100K ACV, I have repeatability. No. Have they bought you because they experienced the same pain? Did it come out of the same budget? Was it the same economic buyer and the same user? Have they, if they were to describe you in 1 or 2 sentences, do they describe you in the same way? I think if that is the case, then the amount of money perhaps you have spent to acquire that initial 5 versus the next 20 may be higher, but what you want to see is that the next marginal dollar that goes in has a higher impact. Yeah. I think that's my sense.
And I think that probably brings us back to the point that I was making around knowing that the customers that you have, that initial group, love your product and are using and really understanding why they're using it, who your buyer persona is, and how that sales process looks for that section. I think companies in our portfolio are still growing 2+. Like we've got companies growing 4x year on year, so growth is still strong. I think, and that's what we like to see as investors, of course, but I think there's a good mindfulness now, even at the early stage, of thinking about that extra dollar spent, but you have to be brave enough to spend it and test. I think at Series A, you're still testing a lot of your go-to-market. You're still testing your sales and marketing spend and product roadmap and what is that extra, product that you want to build and deploy resources to. I think what's changing, what I like to see, is the cadence on that learning curve and being mindful of where that money is going and how long we then give that test to validate itself is trickling through, and founders that might not have thought about that at an early stage are starting to be a bit more conscious. But I do think it's important that you have that flexibility and you're brave enough to spend and test, because ultimately, you have to do that to hit those growth rates. And we can get a bit too, I don't want to sit here and make founders afraid of being brave to do those things.
Okay, thanks. So the other thing that investors in our survey mentioned, not surprisingly, besides the growth and capital efficiency aspect, is AI. We wouldn't do our job if we didn't talk about AI here today as well. And obviously we can only touch the surface in the remaining 6 minutes or so, but I'm curious, to what extent has your thinking changed in the last few years, maybe since the launch of GPT-2 and 3, or finally with the spectacular launch and traction and maybe hype around ChatGPT about a year ago? I'm curious to what extent this might have changed the way maybe you work with your existing SaaS portfolio companies, or also how you're looking at new ones, new potential investments.
I can go. I think like the brief takeaway for me has been that AI is just the logical next step in the evolution of software. And I'm not going to talk, we can debate all we want about jobs and this and that, but I just feel if you're a software founder today, it doesn't matter whether you're building a software for plumbers, or you're building a software for developers, or you're building a software for consumers. If you're not thinking about how to incorporate AI into your business, either as a direct product or just to make your own business operations better, you're probably missing a trick. Because AI is making so many things easier, better, faster, you don't have to incorporate AI in your product, but you should still leverage the advantages that it gets you. So I think you've got to be thinking about it. My personal favorite category, in AI is what I call as the productization of services. I feel services in the world has been like this, or at least in our VC world has kind of been like the stepchild. Nobody wants to talk about services. Just stay away from them. I feel AI is going to make services so much more attractive because you can do the same thing with a higher margin, with better efficiency, with more productivity of your people. So I'm really excited about productizing services through AI. But even if you're not doing that, no matter what company you're building, if it has software somewhere, my view is you should think about how you can use AI to improve your own internal operations or better serve your customers.
I agree. I think it's a technology platform shift in the same way that I've experienced the need for software to be mobile or the need for the software to be delivered on the cloud. I think it fundamentally changes how we deliver and consume software in a new and an exciting way. Maybe finally make no-code true. But it doesn't fundamentally change the fact that it can't be AI for the sake of AI, right? I think there's a lot of hype in the sector, and it's almost like gravity doesn't exist in AI for whatever reason. And so I think for us, we're encouraging our existing portfolio to use the technology to benefit the captive distribution and the products that they have already built. But we are also excited about the net new companies as long as they're utilizing the technology to build a viable product that solves a pain.
I'll add to the mass consensus that we're building on the panel. I completely agree. I mean, with every company we have, or at least in every company I have in my portfolio, I'm talking to them about how can we use this shift and this technology shift to improve our own process, but also the offering that we're bringing to our customers, and how might this disrupt us and the business that we're building. I think it's just a technology you need to be mindful of and incorporate in some way into your business and into your product. In terms of how that then, pure, I would say, AI companies and how we look at them, I think there's been a lot of hype. I think there's quite a lot of very broad horizontal use cases that people are going after, at least, and from my perspective, what I like to see is some focus day one on what is the vertical that you're going into, what is that use case that you're applying the technology to, and how can you productize that and somehow enable the adoption curve, because I think that will be a big challenge in the market. Is actually, we know this technology is there, we know it can improve things in a number of ways, but how can the vertical that you're targeting, how can you help them adopt this, and what needs to be done on making that actually usable and in a business environment?
Evgenia, you mentioned the platform shift, right? I think the last big platform shift in business software was probably like on-premise to the cloud, and most on-premise vendors didn't. Well, maybe some of them didn't survive it, some survived, but they didn't really participate in the biggest value creation, which was done by like Salesforce and ServiceNow and Zendesk and all these new players. Do you think of AI as a platform shift like this? So do you think that most of the value creation in the next 10 years will be done by new entrants? And maybe will companies like Salesforce be killed along the way?
That'd be lovely for all the net new investments we could make, wouldn't it? I think it's a slightly different shift. I think fundamentally you're not reviewing your entire infrastructure, right? I think the shift from saying, I have my boxes here and I'm a bank and I'm coding in COBOL to suddenly delivering certain workflows over the cloud is different to adding elements of generative AI to your product. I think what it will come down to, honestly, is the war for talent. I think the skills that generative AI or even predictive AI require are very different, and I think it will depend on some of those larger incumbents' ability to attract the kind of talent that can push the boundaries of their product forward.
Thank you so much. So we've run out of time, but thank you so much, Melissa, Evgenia, Anant. Thank you for your time. Thanks for all the answers. I'm assuming you're still around for the day. So if anybody has follow-up questions, I'm assuming you're happy to take them.
Of course. Thank you.
Thank you for having me.
Thank you. Thanks, everybody.
Thanks.